There's a thief in your house. You can't see them, you can't hear them, but every single night they're taking money directly from your bank account. That thief is inflation, and its accomplice is the person in the mirror who's too afraid to do anything about it. That's why nearly half of all Americans, 48%, hold zero investment assets. They aren't avoiding risk, they're guaranteeing a loss. The problem isn't a lack of information, it's that our brains are wired to make catastrophic errors with money. We're the risk. But this isn't a problem you solve with willpower. You solve it with a system. I'm not just going to tell you to get over it. I'm going to give you a simple 3-step framework for how to start investing that takes less than 15 minutes to implement, including the exact type of fund you can use as a starting point. It's designed to overcome the specific mental barriers that keep smart people on the sidelines. These aren't just barriers, they're invisible walls. And the first one is built brick by brick from the most primal human emotion, fear. That feeling of dread when you think about losing money isn't a character flaw. It's a feature of your brain's operating system. Research from Wall Street Prep quantifies this. The psychological pain from a financial loss is approximately twice as powerful as the pleasure you get from an equivalent gain. This means to convince your brain to risk losing $1,000, have to be promised a reward of $2,000 just to break even emotionally. The game is rigged against you from the start. Imagine you find a $50 bill on the sidewalk. It's a great feeling, a little jolt of luck. Now imagine you realize you lost a $50 bill. That feeling isn't just the opposite, it's a gut punch. It stings, it occupies your thoughts for the rest of the day. That's the 2-to-1 ratio in action. This is a cognitive bias called loss aversion. It's the first invisible wall, and it's why the safe option of doing nothing feels so compelling, even when you logically know your cash is bleeding value. Your fear isn't irrational. It's a survival instinct that's tragically miscalibrated for modern financial markets. The second invisible wall is analysis paralysis. This is the state of the perpetual researcher, the person with 57 browser tabs open, one for every best ETF for beginners article published since 2018. They have a spreadsheet comparing brokerage fees down to the 4th decimal point. They've watched so many hours of videos that the YouTube algorithm thinks they're a hedge fund manager, but they've never actually bought a single share. A study cited by Kellens found that 73% of people aged 25 to 35 report overthinking, a trait that directly fuels this paralysis in investing. You're trying to avoid a hypothetical 1% mistake, and in doing so, you're guaranteeing a 100% loss against inflation and missed growth. The search for the perfect decision is the perfect way to get the worst possible outcome: nothing. The third wall is a more subtle one: financial imposter syndrome. It's the quiet voice that says, "I'm not the kind of person who invests." It's the feeling that investing is a club for finance experts or the very wealthy, and you don't have the password. You might be thinking, "But I really don't know enough." And that's the trick the syndrome plays on you. It convinces you that you need a degree in economics to buy an index fund. The truth is, you don't need to understand quantum physics to use a microwave. You just need to know which buttons to press. A recent report from RBC found that 44% of millennials who don't invest cite a lack of confidence in their own knowledge as a key reason. This isn't about a lack of intelligence, it's a crisis of confidence. You might have a great job and a solid income, but you still feel like you're standing on the outside looking in, unqualified to even begin. So which of these three walls feels the tallest to you? Fear, analysis paralysis, or imposter syndrome? Let me know in the comments. You'll see you're not alone. And if you're not sure, I've linked a simple checklist in the description to help you self-diagnose. For those who have already broken through one of these walls, share the resource that helped you in the comments. You might help someone else. The first step is always identifying the enemy. Once you do that, you can build the weapon. And this weapon isn't willpower. It's a system designed to make your psychological biases irrelevant by replacing complex decisions with simple, predetermined rules. It's called the 15-minute investor framework. The first step is to choose your vehicle. This is where most people get stuck for months, comparing dozens of brokerage firms. For a beginner though, the choice between major, low-cost firms like Vanguard, Fidelity, or Schwab is functionally meaningless. It's like agonizing over whether to buy a Toyota Camry, a Honda Accord, or a Subaru Legacy. They're all reliable, safe, and will get you to your destination. The small differences in features are irrelevant if the car stays parked in the garage. Your goal isn't to find the perfect brokerage. Your goal is to get on the road. Pick any one of the major reputable names and open an account. This decision should take you no more than 5 minutes. Now you might be thinking, but wait, they do have different fees, different mobile apps, different research tools. And you're right. For your first $10,000 though, those differences are microscopic. We're talking about a potential difference of a few dollars a year. The real enemy isn't a slightly clunkier app. It's the paralysis that keeps your money earning 0% in a checking account. The second step is to pick your first lane. This is the decision that paralyzes people for years. Which of the thousands of available investments do you choose? The system provides a simple answer. You don't choose. You don't try to pick winning stocks. Instead, you buy the entire road. You start with a single broad market index fund. This could be an S&P 500 ETF, which gives you a tiny piece of the 500 largest companies in the US, or a total stock market ETF, which owns a piece of virtually every publicly traded company in America. By buying one share of a fund like VOO or VTI, you're instantly diversified across the entire economy. You've outsourced the impossible task of picking winners and instead made a single bet on long-term economic growth. And let's be clear about what one fund means. You might hear the old advice, don't put all your eggs in one basket. To be clear, buying a total stock market fund isn't one basket. It's one truck that's carrying 500 or even a few thousand different baskets for you. You own a piece of Apple and Microsoft, but also the companies that make the paint for your house and the coffee you drank this morning. It's the ultimate diversification in a single click. The evidence for this approach is compelling. Over the last decade, depending on the exact period you measure, the S&P 500 has delivered an average annual return somewhere between 11 and 15%. Let's make that number real. Imagine you put in just $1,000. An 11% return means that after 1 year, your $1,000 has become $1,110. You made $110 while you were sleeping, while you were at your day job, while you were watching Netflix. The next year, that 11% is calculated on the new total, so your $1,110 becomes over $1,232. That's the power of compounding in action, and it's a power you can only access when you're actually in the market. This isn't a guarantee of the future, but it's a powerful illustration of what you gain by simply being in the market, rather than trying to outsmart it. The investor who starts today with a simple, broad S&P 500 fund is already light years ahead of the genius who spends the next 5 years searching for the perfect investment and never actually buys anything. The cost of being late is infinitely higher than the cost of being imperfect. Consider the story of two friends, Alex and Ben, back in 2014. Alex put $10,000 into a simple S&P 500 fund and didn't touch it. Ben, who was smarter and more careful, spent the next 5 years researching. He wanted the perfect portfolio. By the time Ben finally invested his $10,000 in 2019, Alex's initial investment had already grown to over $20,000. Ben didn't lose money on a bad stock pick. He lost a fortune to hesitation. That story really crystallizes the debate, doesn't it? What's your gut reaction? Team buy the whole market like Alex, or team pick individual stocks like Ben tried to? Let me know in the comments. Stories like that are why it's so important to learn how to handle the inevitable ups and downs of the market without panicking. To learn the framework for navigating market drops, make sure you subscribe, because that's our next deep dive. But this system has a fatal flaw, a single point of failure that can bring the entire thing crashing down. That point of failure is you, which brings us to step 3. Set it and forget it. This step is designed to solve the most dangerous variable in the entire equation. It addresses the belief that you'll check your account every day, panic during a downturn, and sell at the absolute worst moment. And that belief is probably correct. You're human. So, you fire yourself from the job of day-to-day decision maker. Inside any modern brokerage app is a function for recurring investments. You can instruct it to automatically transfer a set amount of money, say $100, from your bank account every 2 weeks, and to automatically use that money to buy shares of your chosen index fund. This isn't a feature, it's the core of the entire strategy. It makes investing a utility, like your electricity bill. It just happens. This systematic approach is the only reliable defense against the emotional biases we diagnosed earlier. It makes your fear of loss irrelevant because the investment happens before you have a chance to feel afraid. Now, let's look at the math, because it's important to set realistic expectations. The goal here is not to get rich in a year. The goal is to build the system and prove that it works. Imagine you set up that $100 a month automatic investment. After 1 year, you'll have invested a total of $1,200. If the market delivers a hypothetical 10% return, your account will be worth approximately $1,255. Now, $55 isn't a life-changing amount of money. That $55 isn't the real price here though. The point is that a system you built in 15 minutes generated $55 for you with zero additional effort, and more importantly, zero emotional turmoil. You built a machine and it's working. The habit is more valuable than the initial return. This system only works if you follow one crucial rule, and it's a non-negotiable part of the framework. Don't check your portfolio frequently. Checking it daily or even weekly is a classic beginner mistake. This is like planting a seed and then digging it up every morning to see if it's growing. All you're doing is reintroducing emotion and the temptation to act. You hired an automated system to do a job. Let it work. Here's a challenge for you. If you set this up, commit to only checking your balance once a month. Can you do it? Comment challenge accepted below if you're in. Of course, the real test comes in 6 months when the news is screaming about a market crash. We'll cover the framework for navigating market drops without panicking in a future deep dive. The thing is, you can't handle a crash if you're not in the market to begin with. So right now, in the next 15 minutes, let's get you in the game. First, take out your phone. Right now, choose one of the major brokerage apps we discussed, Vanguard, Fidelity, or Schwab, and download it. Don't overthink this. The goal is to get on the road, not to find the perfect car. Second, open the app and connect your bank account. Initiate a transfer for a small amount that feels insignificant to you. $100 is a perfect starting point. This isn't about the amount. It's about breaking the inertia. Third, once the funds are available, use the app's search function. Don't look for a company name. Type in the phrase S&P 500 ETF or Total Stock Market ETF. You'll see a few options. Choose the one offered by the brokerage you're using. An ETF sounds complicated, but it's the opposite. It's the simplest starting point. Instead of trying to pick one winning company, you're buying a tiny piece of all the winning companies at once. It's like betting on the whole team instead of just one player. And fourth, the most important step. Before you close the app, find the option for recurring investment. Set it up to invest a small amount on a regular schedule. Even $25 a week is enough to build the system that builds your wealth. That's $100 a month. After 1 year, it's $1,200 you've put to work without a single moment of stress. After 10 years of that consistent automatic action, you could have over $15,000 working for you. This is the step that makes your emotions irrelevant. At the start of this video, I said the greatest risk to your wealth isn't a market crash. It's the person in the mirror. By taking these 4 simple steps, you just fired that person. You replaced them with an automated system designed to work for you, not against you. Congratulations, you're an investor.